One of the good things about putting content out on YouTube is feedback. The good part about that feedback is if you use it properly, you can refine the information that you're putting out. In our first video on the two-bucket strategy, bucket 2 is meant to be for growth and where your money is actually invested in the market. In that video, I used a 60-40 portfolio as the example, where 60% of the money was in stocks, 40% of the money was in bonds. In that video, I used two separate funds to accomplish that, and I effectively created a three-bucket strategy. So thank you to the individual that left that comment, because it got me thinking. There is still a way to achieve a 60-40 portfolio and keep your retirement as simple as possible, and you can do it all just by using one fund. In this video, I'm going to go over two different options that you could use to invest your money in bucket 2 and keep your retirement as simple as you possibly can. Stay tuned. Welcome back to Financial Wellness Planning. My name is Derek Coffey, and I'm the founder of FWP. And the whole point of using a bucket system is to keep your retirement simple. With a bucket system, you can visualize what your retirement income is going to look like. Now, with a two-bucket strategy, you have two buckets. In the first bucket, you put in 1 year of your income need, and ideally, this is 4% of your overall investment portfolio. The other 96% you invest into whatever asset allocation fits your risk tolerance. Now, me personally, I'm a firm believer in a 60-40 portfolio. And the two funds that we're going to go over in this video, their goal is to hold your asset allocation at that 60-40 mix. The first fund that we're going to get into is the Vanguard Balanced Fund. And the whole point of the Vanguard Balanced Fund is to have 60% of the assets invested in US-based companies. The other 40% is invested in US bonds. So if you're one that likes to have a little bit of international exposure within your portfolio, this isn't going to be the right option for you. You should wait around for the other one. But with the stock portion of the Vanguard Balanced Fund, the money is invested in a way that it captures the total stock market. And what this means is you get access to mega cap companies, mid cap companies, small cap, and micro cap, as opposed to just being invested in the S&P 500. And what this does is it gives you access to smaller companies, which can create another layer of diversification within the portfolio. Now, the bond portion isn't as flashy. It just tracks a broad-based index of US bonds. So if we look at the entire portfolio, where 4% of your money is in bucket 1, sitting in cash, and the other 96% is in bucket 2, invested in the Vanguard Balanced Fund, then your portfolio overall breaks down as follows. You have 59% of your money in US stocks, you have 36% of your money in US bonds, and then you have 5% of your money sitting in cash. If you would like to have some international exposure, then you could look into the Vanguard Wellington Fund. Now, it's still going to aim for the same 60-40 portfolio, but it does sprinkle in a little bit of international stocks and international bonds. Now, due to technology and how intertwined all of the world's economies are, there's always going to be an argument on if international exposure still matters. But as you'll see later in this video, when we get into the performance of these portfolios, that international exposure came in handy from 2000 to 2002. Now, if we assume that we're using the two-bucket strategy, 4% in cash, 96% in the Wellington Fund, the overall portfolio breaks down as follows. You have 58% of your money in US stocks, you have 5% of your money in international stocks, you have 26.5% in US bonds, with 5.5% in international bonds, and then you still have the same 5% in cash as we did with the Vanguard Balanced Fund. One thing I want to mention about these two funds is these are the investor share classes. For most people, you're probably invested in an Admiral share class if you use Vanguard. But the reason that I chose the investor share class is because I could pull information from 1993. This gave me a 30-year time frame that we could review the performances of each of these funds, and that's what we're going to get into next. Over the last 30 years, both of these portfolios have performed very well, but what we really want to see is how they compare side by side. What you see on your screen are the annual returns of both of these portfolios. If we start in 1993 and go to the end of 1999, what you'll notice is that there's really nothing different between the two. With the Vanguard Balance Fund, you have just over $2 million by the end of 1999. And then if you're using the Wellington Fund, you have just shy of $2 million. But then 2000 happened. The Vanguard Balance Fund took it on the chin. For 3 straight years, that portfolio lost money. And if we compare that to what the Wellington Fund did, the Wellington Fund only lost money in 2002. And what you're going to notice when we get to the bottom of this sheet is that at the end of 2023, that international exposure is what really helped the Wellington Fund outperform the Balanced Fund. So after 2003, both funds performed quite well. 2008 happened and they both lost 21%. And what I want to point out is around this time is when technology really took off. All of the world economies really started to become interconnected. So after 2008, what you're going to notice is a lot of these returns are close to one another. Yes, there are some outliers, but for the most part, they track the same. 2009, we had really good recoveries and both portfolios had positive years all the way up to 2018. In 2018, the Vanguard Balance lost 2.76%, the Wellington Fund lost 3.2%. 2019, 2020, 2021, all of those years were positive. Then we had 2022, where the US didn't fare as well as the international market. So the Vanguard Balance Fund lost 16%, the Wellington Fund lost 13.69%. And then we get to 2023, Vanguard Balance was up almost 17, the Vanguard Wellington was up almost 14%. So at the end of that 30-year time frame, the Vanguard Balance Fund had $3 million less than the Vanguard Wellington Fund. And a lot of that had to do with the international exposure and the protection that it created in 2000. Speaking of 2000, we did receive a couple of comments on the last 2-bucket video about how the strategy would have worked if you retired into a down market. Well, from 2000 through 2002, that's exactly what happened. If you were using the 2-bucket strategy and you used the Vanguard Balance Fund as your bucket 2 investment, then you experienced 3 straight years of losses. By the end of 2002, if you take into account those losses as well as the income that you would have pulled out for your retirement, you would have lost $250,000, and that would give anyone reason to worry. Now, after 2002, there was a recovery. 2003, 19%, 2004, 9%, and you experienced these gains all the way up until 2008 when everyone got pummeled. So in 2008, you lost 21, and then from 2009 all the way through 2017, you had another string of positive years. At the end of 2023, having 4% of your money in cash, 96% of your money in the Vanguard Balance Fund, you're still going to have $860,000 in your account. And that whole time, we've been taking out 4% adjusted for inflation. So if you were 60 years old in 2000, you're now 83 years old with $860,000 left in your account. And I know it's not the $1 million that you started with. Over the course of these 23 years, you only made it back to $1 million once, and that was in 2021. But if you were 60 years old when you retired in 2000, you're now 83 years old. With $860,000 left in your account, you're not paying for much more than doctor bills at this point. And even if you wanted to go do other things or gift money to your children, etc., you still have $860,000 to do so. Now, if we go over to the Wellington portfolio, you only had 4 down years over that 23-year time frame. In 2000, you made money. In 2001, you made money. In 2002, you lost money, but it was 2.5% better than what happened with the Balanced Fund. 2008, you lost money. 2018, you lost money. 2022, you lost money. But at the end of 2023, you have $1.5 million more in your account. Now, I feel that this has a lot to do with that international exposure and the protection that it created in 2000. So the 2-bucket strategy does work, at least historically speaking. We don't know what stocks are going to do going forward. We don't know what bonds are going to do going forward. But if we compare both of these portfolios starting in 2000, you didn't run out of money over that 23-year time frame. With any investing strategy, there's going to be pitfalls. One of the largest pitfalls of the one fund retirement is that you only have one fund to work with. If you were to have 2, 3, or 4 other investments within bucket 2, then ideally one of those investments is going to be up when the markets are down. To refill bucket one, you would sell the position that's up and then let the others recover. Using the one fund portfolio, you don't get that luxury. With the balance fund, you would have had 7 years that you would have sold at a loss to refill bucket one. And it just so happens that 3 of those years were back to back to back. With the Wellington fund, there would have been 5 instances where you were selling your positions at a loss to refill bucket one. But the thing about that is none of those happened back to back. Because you didn't have those consecutive years of losses, you would have ended up with an additional $3 million in your account. Even though this is one of the most simple yet effective ways to operate your retirement, this is a pitfall that you need to be aware of. And this is especially true if there are consecutive years of losses. In the not too distant future, I'm going to do a video on a 3-bucket strategy. And I'm going to show you how having 2, 3, and even 4 other positions within the account can help keep you from selling something at a loss. I want to thank you so much for tuning in. If this video or any of the other videos that I've put out has provided you value, then hit that subscribe button. If you know someone that wants to keep their retirement about as simple as you can possibly keep it, then send this video to them and tell them to run it by their advisor. But I want to thank you so much for tuning in. I'll talk to you soon.